Jake is throwing every extra dollar at his mortgage. He's going to be debt-free in 15 years, and he can't stop talking about it. Marcus is making the minimum mortgage payment and dumping every extra dollar into the index fund. He's going to be a millionaire, and he can't stop talking about it too. They're both wrong, because the advice Jake is following was written for his grandfather's economy, and the advice Marcus is following was written when mortgages cost half of what they cost today. The rules quietly changed somewhere between 2022 and 2026, and almost nobody updated the math. When you actually run the numbers at today's mortgage rates, the gap between what these two think they're winning and what they actually walk away with will change how you think about your mortgage forever. Let's keep this fair. Jake and Marcus are both 35. They both earn $90,000 a year. Same city, same tax bracket, same goal. Build real wealth and own a paid-off home before they retire. They both just bought the same $400,000 house, both put 20% down, and both took out a 30-year fixed mortgage at 6.5%. That's not a hypothetical rate. That's the actual average mortgage rate in May 2026. Their monthly principal and interest payment is about $2,022. They both have an extra $500 a month they want to put to work. The only difference is what they do with it. Jake puts the $500 toward extra principal. He'll be mortgage-free by year 18 instead of year 30. Marcus pays the minimum and puts $500 a month into a low-cost S&P 500 index fund. He's planning to let it sit there for 30 years and let compound growth do the work. Same house, same payment, same $500. Two opposite philosophies. And almost every viral take you've seen on this debate was written when mortgages were 3%, not 6.5%. That detail matters more than almost anyone is admitting. To understand why both Jake and Marcus could be wrong in 2026, you need to understand what changed. In 2021, the average 30-year mortgage rate was around 3%. At a 3% mortgage, the math behind always invest the difference was overwhelming. The historical average return of the S&P 500 is about 10% before inflation. That's a 7 percentage point spread between what your mortgage cost and what your investments could earn. Over 30 years, that spread compounds into hundreds of thousands of dollars. At 3%, the answer wasn't even close. Invest every time. But it's not 2021 anymore. As of May 2026, the average 30-year fixed mortgage rate is sitting at 6.5%, and most experts don't see it dropping below 6% anytime soon. That's the new baseline, and it changes the math completely. When your mortgage costs 6.5% and a realistic after-tax stock market return is closer to 7%, that 7 percentage point spread from 2021 collapses to less than 1 percentage point. The obvious answer stopped being obvious somewhere between 2022 and 2024, and most of the personal finance internet hasn't caught up. Almost every video, TikTok, and book telling you to never pay off your mortgage early was written in a different rate environment. Anyone giving you that advice today without acknowledging what changed is either out of date or not running the numbers. Year 1 to 5. For the first few years, Jake looks like he's playing it safe. His coworkers tell him he's leaving money on the table. His brother shares a TikTok that says, paying off a low-rate mortgage early is a math mistake. But Jake's mortgage isn't low rate. It's 6.5%, and every extra $500 he sends to his lender wipes out future interest at a guaranteed 6.5% return. That's the part nobody on TikTok is telling him. A guaranteed 6.5% return is not a small number in 2026. High-yield savings accounts pay around 4%. Treasury bonds pay around 4.5%. The stock market is volatile and uncertain. A 6.5% guaranteed, risk-free, tax-free return is genuinely competitive in a way it simply wasn't 5 years ago. By year 3, Jake's mortgage balance has dropped about $20,000 more than schedule. By year 5, he's killed roughly $38,000 in future interest payments. Money the bank was going to extract from him over the life of the loan, gone. Marcus, meanwhile, is investing $500 a month. Year 1 was solid. Year 2 was rough. The market dropped 15%. Year 3 rebounded. By year 5, his portfolio is sitting at roughly $35,000 to $40,000 depending on timing. It feels good when the market's up. It feels terrifying when it's down. Jake doesn't have that problem. His return shows up on his statement every single month in black and white. No volatility. Just a balance going down faster than the schedule says it should. On every emotional scoreboard, Jake is winning. And in 2026, he might actually be winning on the math scoreboard too. Even at today's rates, Jake's strategy isn't perfect. If I only showed you the upside of mortgage prepayment, I'd be doing what every debt-free influencer does. Mortgage debt is still one of the cheapest forms of debt a regular person can access. Credit cards charge 24%. Personal loans charge 12%. Auto loans charge 8%. A 6.5% mortgage is the lowest cost borrowing in Jake's entire financial life. If he ever needs to borrow for anything else, he's paying a much higher rate than the one he just rushed to pay off. Every dollar Jake sends to the bank is a dollar locked inside his house. Home equity is real wealth, but it's not accessible wealth. He can't pay a hospital bill with his foundation. To get that money back out, he has to sell or apply for a HELOC. HELOCs in 2026 are running at 8% to 9%, well above his original mortgage rate. There's also the mortgage interest deduction. If Jake itemizes, his effective rate drops from 6.5% to closer to 5%. Every extra payment is killing interest he was going to deduct anyway. Inflation is also helping anyone with a fixed-rate mortgage. Jake's payment is locked at $2,022 for 30 years. Inflation will make that payment feel smaller in real terms. Paying off early means giving up the chance to repay with cheaper future dollars. And the big one, but every dollar Jake puts toward his mortgage is a dollar he didn't put somewhere else. If Jake skipped his employer's 401k match to throw extra money at his mortgage, that's a 100% guaranteed return he gave up to chase a 6.5% one. That's not strategy. That's a structural mistake regardless of the rate environment. This is where the 2026 rate environment does the most damage to Marcus's strategy. The just invest the difference argument depends on one thing: a wide, durable spread between what your mortgage costs and what your investments earn. That spread used to be enormous. It's not anymore. At a 3% mortgage and a 10% market return, the spread was 7 percentage points. Overwhelming. At a 6.5% mortgage and a realistic 7% after-tax return, the spread shrinks to less than half a point. Add sequence of returns risk, taxes on capital gains, and the fact that 10% is an average, not a guarantee. There have been entire decades where the stock market returned 4% or less. Then there's the tax problem. When Marcus sells, he owes capital gains tax on the growth, 15% federal plus state. If $500 a month grows to $600,000 over 30 years and $400,000 of that is gains, he owes around $60,000 in federal capital gains tax alone. Jake's mortgage payoff doesn't have a tax bill attached. Then there's the behavioral reality. Most people don't actually invest the difference. They mean it when they say it. But life happens. The market drops 20% and they panic. Studies show the average investor underperforms the market by 1% to 2% a year, just from buying high, selling low, and missing the best days. Jake's mortgage doesn't care about emotions. And the part that scares financial planners the most, a mortgage payment is a guaranteed monthly expense. Market returns are not guaranteed monthly income. If Marcus loses his job during a recession, the bank still wants its $2,022. His brokerage account might be down 30% at the exact moment he needs to sell. Jake, sprinting toward a paid-off house, is reducing his fixed expenses every year. Marcus is not. The just invest the difference advice was correct at 3%. At 6.5%, it's a much closer call than the internet wants to admit. Year 5 to 20. By year 10, Jake has paid down his mortgage by about $90,000 more than schedule. His remaining balance is around $208,000 instead of $260,000. His home equity is around $250,000. Marcus, by year 10, has invested $60,000 of his own money. With historical returns and volatility along the way, his portfolio is sitting at roughly $87,000. His mortgage balance is on schedule at $260,000. His home equity is just down payment plus appreciation. Call it $170,000. Add it up. Jake's net worth, around $250,000. Marcus's, around $257,000. Marcus is ahead, but barely. And we haven't talked about taxes yet. If Marcus needs to spend his brokerage money, he owes about $4,000 in federal capital gains. His real after-tax value is closer to $83,000. Jake's home equity has no embedded tax bill, but it's not liquid. By year 15, the gap closes further. By year 18, Jake hits a milestone Marcus literally cannot match. Jake's mortgage is gone. His monthly fixed expenses just dropped by $2,022. Marcus still owes the bank for another 12 years. From year 18 onward, Jake redirects the entire $2,022 mortgage payment plus the original $500, that's $2,522 a month, into investing. He's late to the brokerage party, but he's bringing 5 times more money to it than Marcus ever did. 30 years in, Jake and Marcus are both 65. The house is paid off for both of them. Jake just got there 12 years earlier. Let's run the numbers. Marcus has been investing $500 a month for 30 straight years. At a realistic 7% annualized return after inflation and fees, his portfolio has grown to approximately $612,000. His house is now paid off at year 30. His net worth, about $400,000 home value plus $612,000 brokerage, equals $1,012,000. Subtract the capital gains tax, roughly $61,000. And his after-tax net worth is closer to $951,000. Jake paid off his mortgage in year 18. From year 18 to year 30, he invested $2,522 a month for 12 years. At the same 7% return, that grows to approximately $560,000. His net worth, about $400,000 home value plus $560,000 brokerage, equals $960,000. Subtract capital gains on his shorter window, about $30,000, and his after-tax net worth is around $930,000. The gap between them, the gap that the entire personal finance internet swears is enormous, is about $21,000 over 30 years, less than 2.5% difference. And that's at a 7% market return. Run it at 6%, and Jake actually wins outright by about $40,000. Run it at 8%, and Marcus wins by about $90,000. Run it at 10%, the historical average, and Marcus wins by about $200,000. But run it at 5%, which has happened in real economic history more often than people remember, and Jake wins by close to $100,000. In other words, at today's rates, the outcome depends almost entirely on what the market does over 30 years. There is no guaranteed winner. The math that used to favor Marcus by a landslide now favors him by a slim margin in good markets and turns against him in mediocre or bad ones. The obvious answer used to be obvious. In 2026, it's a coin flip with a slight lean. Year 12. Jake and Marcus are both 47. Something happens. A job loss, a medical bill, a family crisis. They both need $40,000 in cash within 60 days. Marcus opens his brokerage app. He sells $40,000 worth of shares. The money settles in 3 business days. He owes capital gains tax on the gains he sold. Call it $3,000 to $4,000. But he has the cash. Crisis handled. Jake doesn't have a brokerage account. His extra money for 12 years has all gone into the house. His home equity is north of $260,000, but he can't spend equity. He has to borrow against it. He applies for a HELOC. In 2026, HELOC rates are running at 8% to 9%. He pays $1,000 to $3,000 in closing costs. The approval process takes 4 to 6 weeks. If he just lost his job, one of the most common reasons people need emergency cash, his approval is in serious doubt. If he does get approved, he's now taking on new debt at 9% to access the money he already paid the bank. Same emergency. Same dollar amount. Marcus had liquid wealth. Jake had locked wealth. The difference cost Jake roughly $4,000 in HELOC interest plus closing costs plus the stress of approval. Uncertainty during the worst possible time to need money. This is the silent killer of the aggressive prepayment strategy. Equity isn't cash. And life doesn't care that your mortgage is on track to be paid off 12 years early. It cares whether you can write a check today. The Roth IRA we talked about in another video at least lets you withdraw your contributions tax-free in an emergency. A paid-down mortgage doesn't give you that option. Once it's in the house, it's in the house. If I left the story at "it's basically a tie," I'd be doing exactly what the internet does. Jake's strategy genuinely wins in specific situations, and they're more common in 2026 than they were 5 years ago. If your mortgage rate is 7% or higher, and millions of Americans who bought between late 2023 and early 2025 are sitting at rates between 7% and 8%, the math tilts decisively toward prepayment. A guaranteed 7% plus return beats almost any realistic after-tax market return. At those rates, Jake isn't close to even. He's actually ahead. If you're within 10 years of retirement, eliminating your mortgage before your income drops is a structural win. A paid-off house means dramatically lower fixed expenses in retirement, more flexibility, and less exposure to sequence of returns risk in your first decade. When a market crash hurts the most. If you genuinely will not invest the difference, and let's be honest, most people won't, Jake's strategy turns into forced savings. The mortgage doesn't care if you feel like saving this month. It just deducts. For people who have tried and failed at consistent investing, prepayment captures wealth that would have otherwise been spent. If you're self-employed or have volatile income, a paid-off house is insurance. When your business has a bad year, you don't lose your home. That security has real-life value a spreadsheet can't capture. And if the volatility of the market keeps you up at night, Jake's strategy delivers a guaranteed return with zero emotional cost. The personal finance internet loves to laugh at Jake. In 2026, Jake's getting the last laugh more often than they want to admit. Marcus's strategy isn't dead. It just isn't universal anymore. If you locked in a sub 5% mortgage during the 2020 to 2021 window, and there are millions of Americans in this group, you should not be prepaying. Period. The spread between a 3% or 4% mortgage and even modest market returns is still overwhelming. Hold that low rate. Invest the difference. The 2021 math still works for the 2021 mortgages. If you're young, 20s or early 30s, with a 30-plus year horizon, time in the market still beats almost everything. Even at 6.5% rates, decades of compounding give Marcus's strategy room to recover from bad market periods that would derail a shorter horizon. If you have any unused 401k match available, capture it before you do anything else. Skipping a 100% match to throw money at a 6.5% mortgage is one of the worst trades in personal finance, regardless of your rate. If you're a high earner who itemizes and benefits meaningfully from the mortgage interest deduction, your effective rate is well below the stated rate. That tilts the math back toward investing. And if you value liquidity and flexibility, Marcus's brokerage account is the more useful vehicle. Marcus's strategy hasn't lost, it's just lost its monopoly on being correct. Jake and Marcus both walked away thinking they made the smart play. Jake thought paying off the mortgage was the responsible choice. Marcus thought investing was the mathematically correct one. Neither was wrong, but neither ran the actual numbers for the rate environment they were living in. Here's what actually works for most people, and it's not picking a side. Step 1. Capture your full 401k employer match. That match is a 100% guaranteed return on day one. Better than any mortgage payoff, and better than any stock market return. Walking away from it is the single worst trade in personal finance. Step 2. Max out a Roth IRA. $7,500 a year going into an account where the government can never tax the growth, with the flexibility to withdraw contributions in an emergency. Step 3. Build a real emergency fund. 3 to 6 months of expenses in a high-yield savings account paying around 4%. This is the layer that prevents you from breaking into your retirement accounts or taking a HELOC during a crisis. Step 4, and only step 4, is where the mortgage versus invest question actually applies. With whatever extra cash is left, the deciding variable is your mortgage rate. Not your feelings, not a TikTok clip, your rate. Below 5%, math says invest. The spread is too wide, and the long-term return on the market still wins. Don't prepay a 4% mortgage in 2026 just because it feels good. Above 7%, math says prepay aggressively. The guaranteed return is too high to pass up, and the after-tax market return doesn't reliably beat it. Between 5% and 7%, which is exactly where most of America actually lives in 2026, split the difference. Half toward extra principal, half toward a brokerage account. You capture the guaranteed return on prepayment. You capture the upside of the market. You maintain liquidity, and you sleep better than someone who went all in on either side. The break-even isn't a feeling. It's a number. And the number depends on one thing: your mortgage rate. The real trap isn't paying off your mortgage early, and it isn't investing every spare dollar. The real trap is taking advice that was written for a different rate environment and pretending the math hasn't changed. It has. The people who are quietly building real wealth right now are the ones who stopped picking teams and started running their own numbers. If you're wondering how the math changes when you compare both of these strategies against not buying a house at all, renting and investing the entire down payment instead, that's a completely different conversation. And the answer might be the most uncomfortable one yet. But for now, the next time someone tells you to always pay off your mortgage or always invest the difference, ask them one question. What rate are you assuming? Because the answer that ignores the rate is the only answer that's guaranteed to be wrong.